Okay, so you all don't watch cricket? I don't blame you, the way the team has been performing, almost losing to Oman. I don't blame you for not following cricket, right? But usually a cricket team has 11 players, and there are people who are called batsmen. Some people are called fielders, and there are other guys who are called bowlers, right? Now, well, if you don't follow cricket, you follow only same case, something similar, right? Or baseball. Okay, but if you take a six-a-side team, there you have only six players. Now, if you take a typical cricket team, right, can you have it has 11 players now? Can you have 11 batsmen in a cricket team? Why not? Why can't you have 11 batsmen or 11 wicket keepers, 11 bowlers? Why don't you do that? Isn't it good to have 11 batsmen? Everybody from 1 to 11 can bat. Perfect batsman, as good as opening batsman. Why can't you have that? Yeah. How come you can't have 11 batsmen or 11 wicket keepers? Perhaps 11 bowlers. Why not? Okay, so the team has to bowl. Need to have people who can bowl. So you have to have bowlers. Yeah. What you're telling is true, right? Now, if you have 11 batsmen, fine. You might score 1,000 runs in 50 overs, but you will also equally get hammered, no? Without any bowlers to defend the score. Likewise, if you have only bowlers, you get everyone else, the other team out for 100, but you will get all out for 25. Right? So it's not going to help. If you have 25 wicket keepers, there is no one to bat, no one to bowl, right? You get hammered all around. So that is not going to help either, right? Which is why you need to have a good mix, so that maybe typically you have five batsmen, a wicket keeper, and five bowlers, right? So perhaps if batsmen fail, maybe the bowlers will do well, and there is a balance in the team, right? Overall, the team does well. But if you, okay, let's say you have five batsmen in a team, five batsmen, a wicket keeper, one wicket keeper, and five bowlers, right? Right. So all five batsmen, okay, if you have left-handed batsmen, all are very slow. All left-hand batsmen very, very slow. Is that going to be useful? Then bowlers, you have right-arm bowlers, all fast bowlers bowling at the same pace, no variation. Each and every ball is the same, only the name is different. Is that going to be of any use? Yeah. So yeah, today's topic is going to be entirely about cricket. So the World, T20 World Cup is also around the corner. Today we can devise a strategy for that. Yeah, Dinesh, you're trying to say something. What do you think? Can you have 5 batsmen? Not very clear.
So we have to think about the other team's performance.
Yeah, you have to
And
think
then
about
we
other teams'
plan
performance
accordingly.
also. Okay. Right. So you have 5 left batsmen, all very slow. Is it good or bad? Is it a good combination or a bad combination? All 5 left-handed batsmen, strike rate of 25. What do you think? Good combination or a bad combination? Yeah. And 5 right arm bowlers, all the same pace, no variation at all. That's good to have or bad to have? Such a combination. What do you all think?
Bad,
Why is it bad? Yeah. Okay, it's bad. Why?
because if there is someone who can hit other team
Yeah.
for that right arms, all get hammered, no?
Okay. Yes, you're right. Okay, so if you have 5 left-hand batsmen, all with a strike rate of 25, then after 20 overs, you will end up with a score of around 30. No, that's not going to help, no. So you need to have different types of batsmen. No? You need to have maybe right-handed batsman and left-handed batsman both, a mix, right? Every other batsman is a left-hander, or you have 2 or 3 left-handers at least in the team. Then out of the batsmen, some should be very aggressive, like some should be like Sanajay Suryas or Shahid Afridis. Others should be very defensive, technical, correct, right? And there should be someone who can hold the innings together. If there are wickets falling at the other end, they should be able to hold things tight. Then there should be a guy who is good at tactics, keep the team spirit going. Then if you take the bowlers, you should have maybe right-hand bowlers, left-hand bowlers, fast bowlers, spinners. Then even among spinners, you should have leg spinners, off spinners, right? Mystery spinners, all types of guys. So you put a combination. From this, you select the best players and you make a combination so that your team is strengthened by that combination. Your team is not weakened, but it is strengthened, right? So where you bring in various skills so that the team benefits in the end. Which means if say one batsman fails, there are still some more batsmen who are different, who have different skills, different abilities, to still try and put up a decent score. Yes, that's why you need to have a team with diverse skills. So diversity adds value to a cricket team, not only to a cricket team, to any organization. So this diversity is called diversification. Right? So what diversification does is it reduces risk. In other words, you have already learned the concept of diversification. Right? There is nothing new to learn. It's something that you already know. This is just a slightly more technical evaluation of what you already know. Right? So that's called portfolio theory. How you manage your portfolios, your investment portfolios. Now the same thing, right? If we impose the same concept into managing funds, right? So if you have been given 100 million rupee fund, right, to manage, and you are managing 100 million rupee fund, right? Where will you invest your money? How will you invest your money? If you're managing 100 million rupee fund, how will you invest your money? What do you think? Where will you put your money?
part in treasury bills?
In treasury bills, okay. You have 100 million to invest. How much will you put in treasury bills? Percentage. How much will you put in treasury bills? Will you put 100% in treasury bills? Meaning the 100 million, entire 100 million, will you invest in treasury bills? What do you think?
In banks,
In banks, okay. FDs, right? That's what you mean, no?
yes, sir.
How much in FDs?
Say 25.
Another 25. Right. So out of this 25 million, will you put everything in 1 year FDs, or how are you going to split it? Are you going to split it amongst the different maturities, or the entire 25 million in one maturity?
Split it
Oh,
for different durations.
like what? 1 month?
Say 6 months and 1 year.
Okay. 6 months, 1 year. Treasury bills? Are you going to put everything in 1 year treasury bills? Again, you can split. No? You can put in 91 day, 182 day, and 364 day treasury bills. And FDs. Right? So that's 50 million. What else? Where else will you invest? Yeah.
Property mortgage, buying land or apartment,
Right. So real estate.
real estate.
How much in real estate?
15%.
15%. Right. You buy everything from Colombo 7?
No. Suburbs
Okay.
plus some easy access, not in Columbus 7. Somewhere close by to some schools or
Oh. Highway?
yes.
Good. What else?
Can leave kind of 5% in the savings account for any emergency requirements or to do some spending, day-to-day spending. 5%.
What else?
Stock market?
Okay. How much in stocks? Yeah.
10% around?
10% in stocks. It comes to so far 80%. Where else? How about unit trust? Maybe 10%. Yeah. And you have left with another 10. Where will you invest that?
In a partnership business.
Okay. In a business venture. Yeah. How about something like gold? Silver? Gold, silver, platinum, all that, right? The balance 5%. Meaning the total comes to 100%. Right. So your savings you have, then the stocks. Now, will you buy with the 10 million? Will you buy the entire lot? For the entire lot, will you buy John Keys equity? What do you think? Will you be 100% invested in John Keys? Yeah. Hello. Hello.
No, it's also split.
Yeah, you should split it amongst several stocks, right? So you invest in not one stock, but many stocks, which are fundamentally good. Right? So you might invest in stocks of A, B, C, or D. Not just one stock, but a few. Then unit trust, you can use various types of funds. Business ventures, precious metals, you can buy maybe gold, silver, platinum, all that. Right? Business ventures, you can invest in different types of ventures. Right, now if you look at this, right, you have invested in various kinds of assets. So each of these assets have common features. For that reason, these are called asset classes. asset classes. Assets with similar features are called asset classes. Things like treasury bills, treasury bonds, equity, like real estate. They're called asset classes. And amongst asset classes, you need to split amongst maybe maturities, kinds of securities, or the risk that they carry, right? Things like that. So the more granular you get and the more dispersed your split, the lower the risk you're facing, right? So that's why how it works. Okay, now if you look at this concept, this is what you mean by diversification. That means you try to manage your risk by investing in, say, various types of assets, not just one asset. That's called diversification. Modern portfolio theory says that in a portfolio of assets, the aim is typically to maximize the expected return for a given amount of risk, right? Or to minimize the risk for a given level of expected return. That is what portfolio theory aims to do. By carefully choosing the portions of various assets, the basic assumptions of modern portfolio theory have been widely challenged by the fields such as behavioral economics. Right? So people are now focusing on the other types of theories like behavioral economics, because there is supposed to be a world beyond this. Now let me show that by a diagram. Remember? The second point in this slide, right? So the first and the second, maximize the expected return for a given risk, or minimize the risk for a given level of expected return, right? So let me show it by a diagram. Very interesting theory. It was developed by a person called Harry Markowitz. So what he says is a rational investor will invest either in the asset that gives the highest return for a given risk, or has the lowest risk for a given return, right? Very important concept. A rational investor will invest in an asset which gives the highest return for a given risk, or the lowest risk for a given return. That's all you need to understand about modern portfolio theory. If you understand that concept, the rest is a piece of cake. Highest return for a given level of risk, or the lowest risk, the highest return for a given level of risk. Right. Let's take these three portfolios, A, B, and C. You're plotting them against the expected risk, return, and standard deviation, right? Now, can you tell me, if you all remember, what the standard deviation measure? What does standard deviation measure? Yeah. Yeah. What do you think? Hello? Right, so if you are given three portfolios, A, B, and C, with the expected return and standard deviation, which portfolio will you pick? Now, what my question was, what is measured by standard deviation? What does standard deviation measure? Hello, I think we discussed last week. Can you remember that? What does standard deviation measure? Any idea? Does anyone remember? What does standard deviation measure? Very important concept. Yeah. No one remembers? 2 weeks is a long time period. It's called short-term memory loss. Standard deviation is a measure of risk. Okay, a very important concept. Right? Don't forget, standard deviation is a measure of risk. Meaning, how does it work? Higher the risk, higher the standard deviation, or higher the risk, lower the standard deviation. What sort of a relationship does standard deviation have with risk?
Confidence
Inverse
and the
relation.
significance.
Okay, yeah,
95,
standard deviation.
95% confidence, 5% significance equals 1.65.
Right. Okay. So that is value at risk. The Z score at those levels. But don't confuse it with standard deviation and risk. No, because standard deviation measures risk. Okay. I will explain using another example so that you all will understand, hopefully understand it better. Right. Let's say there are again two cricketers. The first guy, let's call them 1 and 2, or A and B. Let's say A scores 5 innings, he scores 0. Sorry. 4 innings, he scores 0. Then the fifth one, he scores 200. Right? He scores 60, 40, 30, 70. Out of A and B, who is better?
B.
B is better. Why?
Contributed for all innings.
Okay. But how much has A scored total? 200, no? B also scores 200, right? Each of them have scored 200. What can you say about the averages? How do you calculate average? Yeah. Average, how to calculate?
Total marks divided by number of games.
Good. So it's a total of 200 divided by the number of matches is 4. He has an average of 50. Then how about B? What is B's average? It's also 50. Which means if you look at the averages alone, who is better? A or B? Average alone.
Both are equal. No?
Both are equal. Okay. Meaning, average doesn't give us an indication of risk, right? But out of these two cricketers, which one is riskier? Riskier?
A.
A is riskier, right? He either hits out or gets out. Right? If you do a calculation, right, of average minus x, right? Average is 200 minus x is 0. So here you get 200. Again 200, 200, and 0. If you do the same thing for B, right, and then it should be 50, no? Average is 50, 50 again 50, and here it's minus 150. Minus 60 is minus 10. 50 minus 40 is 40. 10, sorry. 50 minus 30 is 20. And 50 minus 70 is minus 20. Right? Well, actually, this should have been x minus average. I'm sorry. So sorry. So x is 0. Minus average is minus 50. Again, minus 50, minus 50. And 150. Whereas here you get minus 10, 10, 20. Minus 20, right? Now you calculate the average of x minus average. Okay. As if you do it right. So the next step is to take the square root of this. Right. So this is the square root of this, the totals of this column. Right. Now if you look at these figures, highlighted ones highlighted in red, which one is larger? A, is it larger for A or for B? This is a rough calculation of standard deviation. It's larger for A or for B? Yeah, for A. Quite obviously for A. earlier conclusion was what? Which batsman was riskier, A or B? Remember? Original conclusion? Was who is risky?
A.
A is risky, right? A is risky and the standard deviation is larger, right? Understood the concept? So it has a positive relationship. That means the larger the standard deviation, what? Higher the risk or lower the risk?
Higher the risk.
Higher the risk. Okay, so remember that concept. Huh? If the standard deviation is large, that means the risk is high. So high risk, high standard deviation, positive relationship. Understood? Clear? Any questions on that? Okay. So that is what you get here. Yeah, if you are plotting the return against standard deviation, the standard deviation, in other words, is what? It measures the. It measures what?
Risk.
The risk. The risk. Yes. So as you go to the right, the risk level increases or it reduces when you go to the right of the x-axis. As you go to the right, the risk increases or reduces?
Increases.
Increases, right? Okay, so if you are given three portfolios, right now these three portfolios are A, B, and C. A could have, let's say, what we discussed earlier, right? These assets, 25% treasury bills, 25% FDs, and 15 real estate, likewise. Whereas B could have different proportions. Maybe bills 20%, treasury FDs 5%, real estate 10%, savings 0, 5, likewise. C will have yet a different portfolio. This could be 10, it could be 30, 25, likewise. Okay. This, right? So A, B, and C are three different portfolios, right? A portfolio is a collection of asset classes. Yeah. Now, out of these three portfolios, which one will you prefer? A, B, or C? In it and think about it. Out of A, B, and C, which one would you prefer? Yeah. What do you think? Out of A, B, and C, what would you prefer?
A.
A. Right. Reason?
Because he has diversified all funds in most of the instruments. If you take B and C, there's zero investment, and in C there aren't any investment in business venture.
Yeah. 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 Yes, you're quite right. And if you take A and B, right, which one would you prefer, A or B? Why would you prefer A between A and B? Important concept, huh? You need to understand these things.
I think it's B, sir, because the diversification is, although its savings is zero, it's proportionately diversified. 20, 25, 20 likewise.
Okay. But between A and B, which one has the, what can you say about the return of A and B?
Sir, we have to calculate the standard deviation and then only we can decide, no?
Well, actually, standard deviation is given, no, in this graph. Let's see, the x-axis is standard deviation, isn't it?
All right, okay, okay, sir.
Yeah. What can you say about the return between A and B? Same or different?
There's a standard deviation is higher for B than A, which
Okay.
means the risk is higher,
Yeah.
which means the return is higher. Higher the risk.
Look at A and B, right? What can you say about the return of A and B? Return is the same, isn't it? Same return. Am I right? A and B gives the same return, correct? But which one carries a higher risk? As you said, B has a higher risk. Same return for both investments, but B carries a higher risk. So you prefer to invest in A or in B?
A.
Obviously in A, right? No one will want B. Then you take B and C. What is same between the two? What is equal between the two?
Standard deviation equal.
Yeah, standard deviation. In other words, risk is the same, no? But return.
A is higher.
C has a higher return. B has a lower return, right? Which one will you prefer?
C.
Obviously C, right? So you will either prefer to invest in A or in C. No one will want B. That's because investors are rational and they will decide on the investment which gives the highest return at a given risk, right? The highest return at a given risk. That means between C and B, they prefer C. Or at a given risk, the highest return. Sorry, at a given return, the lowest risk. And between A and B, they will prefer A. Return is the same, low risk is A. So investors will prefer to invest at the highest return for a given risk or the lowest risk for a given return. Understood? That's what is meant by what we discussed earlier. Maximize the expected return for a given amount of risk or minimize the risk for a given level of expected return. By carefully choosing the proportions of various assets, but these have been challenged through behavioral economics, right? Behavioral economics means investors don't behave rationally. They have various other thoughts that go through their mind before they make investment decisions. That's called behavioral economics, right? Now, the main two types of risk are called systematic risk and unsystematic risk. Okay, systematic risk is the risk within the system. Now, if you take the Sri Lankan cricket team, right, you have systematic risk and unsystematic risk, right? Because no matter what combination of bowlers or batsmen you put, our guys still lose, right? That is called systematic risk. They are all Sri Lankans. Maybe there is different deficiencies in the team, which leads to negative results, right? So that cannot be eliminated by changing players. That's called systematic risk. Whereas the performance level can be improved if you put the right bowlers and the right batsmen in the proper combination. That's called unsystematic risk. Right? Unsystematic risk is the risk which can be minimized through diversifying. Unsystematic risk is the company or industry specific risk that is inherent in each investment. Unsystematic risk can be reduced through diversification. That is the most important concept. Remember that unsystematic risk can be reduced through diversification, right? Whereas systematic risk is the risk inherent in the entire market or an entire market segment, and not just a particular stock or industry. This type of risk is both unpredictable and impossible to completely avoid. It cannot be mitigated through diversification, only through hedging or by using the right asset allocation strategy.
So excuse me, we don't see
Yeah.
the presentation.
Oh, you can't see it. Sorry. This one, systematic risk and unsystematic risk. So systematic risk cannot be diversified. Systematic risk cannot be reduced through diversification, whereas unsystematic risk can be reduced through diversification. Okay, this is how it goes. As you keep increasing or diversifying the portfolio, that means you keep increasing the number of securities in the portfolio, your overall risk comes down. But at a certain point, it levels out, right? It doesn't reduce beyond that. Okay, so what you can eliminate by increasing the number of securities is called unsystematic risk. Whereas the risk that you cannot eliminate by increasing the number of securities is called systematic risk. Diversification is a risk management technique that mixes investments within a portfolio based on the premise that a portfolio of different kinds of investments will pose a lower risk than any individual investment found within the portfolio. It's a risk management techniques that mixes investments within a portfolio, right? So that's the important thing. It mixes investments within a portfolio based on the premise that a portfolio of different kinds of investments will pose a lower risk than an individual investment found within the portfolio, right? So instead of having 11 batsmen, you have various combinations of batting and bowling skills to form a cricket team. By changing that combination, you can come up with the best possible cricket team. Diversification strives to smooth out unsystematic risk. Remember, diversification can reduce unsystematic risk only in a portfolio so that the positive performance of some investments will neutralize the negative performance of others. Benefits of diversification will hold only if securities in the portfolio are not perfectly correlated. Important point. Diversification benefits can be reaped only if securities in the portfolio are not perfectly correlated. Now, what do you mean by correlation? What do you mean by correlation?
Mutual relationship between securities.
Yeah. Correlation, right? It can be perfect negative or perfect positive. Right, so correlation moves between -1 and +1. -1 means perfect negative correlation. +1 means perfect positive correlation. So what do you mean by -1? If correlation is -1, what does it imply? Perfect negative. Right now, example I can give is if you all are married, right? If you guys are married, and whenever you say yes, if your spouse says no, then that is perfect negative correlation. And when you say yes, if your spouse says yes, no, that is also perfect negative correlation, right? Opposite. But whenever you say yes, your spouse also says yes, that is called perfect positive correlation. When you say no, the spouse also says no, perfect positive. Perfect negative is the opposite. Understood? That's correlation. Now, in terms of securities or financial instruments, they move, or the strength of the relationship is measured through correlation. Okay, so for you to have correlation or diversification benefits, your correlation should be anything less than perfect positive. Right? At perfect positive, there is no correlation at all. Okay. Maximum diversification comes when your correlation is perfect negative. Here you get maximum diversification. Perfect positive, there is no diversification. Okay. So this is how correlation works. It ranges between perfect negative and perfect positive. It's perfect negative, you get maximum diversification. Perfect positive, there is zero diversification. Clear? Combining assets with low, zero, or negative correlations, it is possible to derive portfolios that have lower risk than either single asset, right? Now, when you combine portfolios or asset classes to form a portfolio, the most important thing is you have to find assets which have less than perfect positive correlation. Anything below one, you get diversification. A diversification benefit is a reduction of portfolio standard deviation, in other words, risk, without an accompanying decrease in expected return. So that's very important. You reduce the risk, but there is no drop in return. Modern portfolio theory is a mathematical formulation of concept of diversification in investing with the aim of selecting a collection of assets that collectively has lower risk than any individual asset class. Modern portfolio theory aims to reducing risk through diversification. Different types of assets often change in value in opposite ways. Right? The price of stocks move differently to the price of bond markets. Right? The stock market and the bond market move usually in opposite directions. A collection of both types of assets can, in theory, face lower overall risk than individually. Diversification lowers risk even if assets returns are not negatively correlated. Right, so diversification will reduce risk. This is not a must that you have perfect negative, but anything below perfect positive gives diversification benefits. Technically, modern portfolio theory models an assets return on a normally distributed function, or the bell curve, if you all could remember, right? Remember, normal distribution curve is called the bell curve, or a Gaussian distribution. It defines risk as a standard deviation of return. Remember, risk is the standard deviation. Models a portfolio as weighted combination of assets. Hence, the portfolio return is a weighted combination of asset returns. Right? What do you mean by weighted average? Again, I'll explain using an example. Let's say you're buying apples. You go to supermarket A, right? Maybe Cargill's. You bought 10 apples at a price of 100. Then you go to B, perhaps Keys. You bought 20 apples at a price of 75. Go to C, and you buy 30 apples at a price of 50. Now, what is your average or the weighted average cost of an apple? How would you calculate? Yeah, can you calculate the weighted average cost of an apple? Yeah. What is your weighted average cost of an apple? How do you calculate? You multiply the number of apples into the price. And you calculate the weighted average cost of an apple. Right? No, this was your capital. And this is the cost.
So Excel is not shared.
Oh, sorry. Hold on, guys. My computer got stuck.
Sir, you are on mute, I think.
Yeah, sorry about that. Sorry. Was I on mute from the beginning?
Yes,
Yes,
sir.
yes.
Oh, okay. Right. So you understood how to calculate the weighted average cost of capital? Take the total cost. I take the total cost and divide by the amount of capital. You get the weighted average cost of capital, right? So that is what was referred to in these slides. I just explained how to calculate weighted average cost of capital. It assumes that modern portfolio theory assumes that asset returns are normally distributed. It defines risk as the standard deviation of return and models a portfolio as a weighted average, a weighted combination of assets. Portfolio return is a weighted combination of asset returns. Right? It combines different assets whose returns are not perfectly positively correlated. It seeks to reduce the total variance of the portfolio. In other words, total risk of the portfolio, right? So remember, risk is measured by standard deviation as well as variance. Now, variance is a square of standard deviation. Modern portfolio theory assumes that investors are rational and markets are efficient, which is not the case. Rational investors means an investor is risk averse, right? They will either go for the highest return for a given risk or the lowest risk for a given return. That's a rational investor. Efficient markets means markets have unlimited, you can borrow or lend unlimited amounts at the risk-free rate. There is no transaction cost. Everyone has the same amount of information. That's called an efficient market. Criticisms of modern portfolio theory: financial returns do not follow a Gaussian distribution or any symmetric distribution. Correlation between asset classes are not fixed but can vary depending on external events and especially in a crisis. Growing evidence that investors are not rational and markets are not efficient at behavioral economics. So these are the criticisms. Asset classes, what we explained earlier, it pools assets with similar characteristics, attributes, or return and risk relationships. Asset allocation is a process of dividing portfolio amongst major asset categories such as bonds, stocks, or cash. The purpose of asset allocation is to reduce risk by diversifying portfolio. The ideal asset allocation differs based on risk tolerance of the investor. Right? Risk-averse investor is an investor whose general desire is to avoid particular participation in risky behavior, in this case, risky investments. investors typically wish to maximize their return with the least amount of risk. When faced to investment opportunity with similar returns, a rational investor will choose the investment with the least risk. Right? So you will either choose A or C, and no one will choose B, because all of us are rational investors. Efficient portfolio, meaning you get various combination of asset classes, right? Like these portfolios A, B, and C, you get D with various other combinations, and you get the portfolio for each of those which has the highest risk for a given return, right? That is called an efficient portfolio. Then what you do is you plot the risk versus the return of each of these portfolios. Then you get an efficient frontier. A portfolio that offers the highest expected return for a given level of risk as measured by variance of standard deviation. Right? So this is a simple return calculation. Okay, that's like you invest 100 rupees at the beginning of the year. At the end of the year, if you sell it for 105, and in between you get a coupon of 5, then your total return will be the ending value of 105 minus beginning value of 100 plus the cash flow of 5 divided by beginning value of 100. Right? You get a 10% return. Then plugging probability into expected return. Right? It says the average possible combination of asset returns, right? So these are the probabilities, and here you get 5% return, 10% return, 15% return, 20% return, 30% return. It's 25%. Probability of getting 15% return is 40%. What do you think happens if you add up all the probabilities? How much will you get? If you add up all the probabilities, how much will you get? If you add up all the probabilities, you will get 1. Right? So let's see the probability into the return. Okay, so it's 5%, the first one. You multiply the columns of 5% into 10%, and 10% into 25%, 15% into 4%, 20% into 20%, 30% into 5%, right? And you add them up. You get 14.5% return, right? So you are weighting your return by the probability of those returns. So your weighted average return will be about 14.5%. Expected rate of return is the weight into the return percentage, right? Risk. Now, risk we discussed last week also. We defined risk as the downside of uncertainty, remember? Okay, so risk arises due to uncertainty of future outcomes, and there could be a probability of an adverse outcome. Risk aversion. Given a choice between two assets with equal rates of return, investors will select the asset with the lowest level of risk or the highest level of return. That's called risk averse. Okay. Expected return we covered. It's similar to the probability weighted return. Our next concept is variance, right? Now, variance is a square of standard deviation. Standard deviation is a measure of risk. Therefore, variance is also a measure of risk. Right? A variance of the rate of expected return of an individual asset. Right? Variance. Right. Now, this is the return minus the average squared. Remember what we did earlier for the two cricketers? This one. Okay, so this is the variance, square of standard deviation. Standard deviation is a measure of the dispersion of a set of data from its mean. Right? Remember the cricketers example? Right? Both cricketers have averages of 50. Right? Both cricketers have averages of 50. Isn't it? If you could remember. These are the averages. Huh? Both had averages of 50. Then you get the average minus score squared. Right? Deviation is a measure of the dispersion of an asset of data from its mean. The more spread apart the data, the higher the deviation. Standard deviation is calculated as square root of variance. So going back to the cricketer's example, okay, far further out the standard deviation, higher the risk, right? Bigger the standard deviation, higher the risk. Okay, remember this batsman A was seen to be riskier than B because A had a bigger standard deviation than B. Standard deviation applied to the annual rate of return of an investment to measure the investment's volatility, right? So standard deviation measures volatility. If you have two assets in a portfolio, let's say you have 50% in bonds, 50% in stocks, this is how you calculate standard deviation of such a portfolio. It says standard deviation is the weighted average into standard deviation of asset class 1 squared plus weighted average into standard deviation of asset class 2 plus 2 times the weighted average of 1 into weighted average of 2 into the correlation into standard deviation of 1 times standard deviation of 2. Okay, so this is where correlation comes into play. Now, if this R term is 1, right? Your portfolio standard deviation, that means if it's perfectly positive correlated, your portfolio standard deviation would be W1 sigma 1 times W2 sigma 2 squared. On the other hand, if you had a standard deviation, sorry, a correlation of -1 or perfect negative correlation, your portfolio standard deviation would be W1 sigma 1 squared plus W2 sigma 2 squared minus 2 times W1 sigma 1, sorry, W1 W2 times sigma 1 sigma 2. So that comes effective to W1 sigma 1 plus W2 sigma 2 squared, sorry, W1 sigma 1 minus W2 sigma 2 squared. Okay, by any chance, if this correlation term was 0, this entire term will be 0, then you will end up with W1 sigma 1 squared plus W2 sigma 2 squared. Shall we try this example? Okay, under control. All you need to do is use this equation. This one you should know by memory. $75 $25 means bond is 0.4, stock is bond is 0.75, stock is 0.25. These are the weights. Standard deviations would be
So Excel is not shared.
sorry. Okay, you need to always write the equation and do it. Correlation 0.9. And also the weighted average return. %13.5%. Okay. Then the steps to building a profitable portfolio. These are common sense techniques. Determine the appropriate asset allocation for you. So your requirements might be different to others. So you have to have your own unique set of strategies. You need to ascertain your financial position. That means what is your net worth? How much can you trade with? What are your requirements? Then your investment goals, your age, purpose. How old are you? What is your objective? How much time you plan to grow your investments? Are you a long-term investor or short-term investor? Amount of capital available and the future capital needs. Correlation. You don't have to know these exactly, but just have a rough idea. Correlation means the strength of a relationship, right? It's a score variance divided by the two standard deviations. You won't get calculations and you won't get even tested. Step to building a portfolio continued, your personality and risk tolerance. The degree of risk you wish to take for the possibility of greater returns. Limits, if any, should be allocated among different asset classes. Then the possibility of greater returns comes at the expense of greater risk of losses, right? So risk-return trade-off. Higher the risk, higher the return. You do want to eliminate risk, settling down to lower returns. You can't eliminate risk, not possible. You will want to optimize it for unique condition and style. Risk-return trade-off is the low levels of uncertainty are associated with low potential returns. So you take low risk, you have low returns. High levels of uncertainty are associated with high potential returns. The risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible return. A higher standard deviation means a higher risk and possible higher returns. Right? So it's a positive relationship, lower the risk. Negative relationship, lower the risk, lower the return, and higher the risk, higher the return. I said negative, I think, but it's positive relationship. Low risk, low return, high risk, high return. An investor faces substantially greater risk and volatility to get an overall return that is higher than a predictable government security. We call this additional risk the risk premium. And so if you invest in government bonds, they are supposed to be risk-free assets, in the sense credit risk-free, right? So if you invest in those, your return will form the base case. What you should expect is something on top. Determining what level is most appropriate isn't an easy question to answer. Risk tolerance differs from person to person depending on goals, income, and personal situation factors. Okay, so it is different from one person to another, also from one company to another. Depends on the experience, the ability, and the risk tolerance level, the amount of capital, things like that. Capital asset pricing model. Investors need only know the expected return, right? Now, these are the assumptions that comes into the capital asset pricing model. Right? Investors only need to know the expected returns, the variances and covariances of returns to determine which portfolios are optimal for them. CAPM might be tested, by the way. Investors have identical views about risky assets, mean returns, variances of returns, and correlations. Investors can buy and sell assets in any quantity without affecting price, and all assets are marketable. Investors can borrow and lend at risk-free rate without limit, and they can short sell any asset in any quantity. Okay, so these are typical to efficient markets. Investors pay no taxes and returns and pay no transaction cost on trades. Right, so it's the efficient market assumption that is being used. You assume markets are efficient. That is why all these assumptions come into play. The following equation describes the expected return of all assets and portfolios, whether efficient or not. Expected return is equal to the risk-free rate plus beta into market risk minus the risk-free rate. Right? So the market risk minus risk-free rate is called the risk premium. Now, if beta is 0, then effectively you have invested in the risk-free instrument, right? And if beta is 1, then your return will be the market return because the market has a beta of 1. Beta is the sensitivity of your return against market returns, right? This equation is referred to as the capital asset pricing model, and its graph is called the security market line. You will not be tested to that extent. Beta is a measure of the asset sensitivity to movement in the market. Now remember, when we did interest rates, we discussed duration, right? So duration measures the sensitivity to movements in interest rates, bound price sensitivity to changes in interest rates. So likewise, beta measures the sensitivity to market. When the market moves by 1%, by how much does your share move? That is measured by beta. Now, incidentally, beta is published on the CSE website. When you search for a stock, it pops the beta value straight away. So it's a measure of the market sensitivity to movements in the market. That means beta can be, if beta is more than 1, it means the share is more sensitive than the market. But if beta is less than 1, it means it is less sensitive. CAPM says that the expected return has two components, the risk-free rate and extra risk. The term market risk minus the risk-free rate is the expected return on the market, or the expected excess return on the market, which is called the risk premium. Beta less than 1 indicates less than average market risk and earns a smaller expected excess return, right? So if beta is less than 1, your portfolio has lower sensitivity to the market. If beta is equal to 1, that means your sensitivity is equal to market sensitivity, right? So if the market changes by 1%, your portfolio also reasonably can be expected to change by 1%. And if the beta is more than 1, that means your portfolio is more sensitive than the market. So if the market changes by 1%, your portfolio is likely to change by more than 1%. Now, how can you use the knowledge of beta? That's the most important thing. If markets are going up, what do you think you should have? A beta more than 1 or less than 1? If markets are going up, your beta should be more than 1 or less than 1. What do you think? If the market is trending upwards, should you have a beta which is more than 1 or less than 1? Now, if the market is going up, you want to maximize your return or minimize your return? Yeah? Maximize. So if you are to maximize your return, your beta should be more than 1, right? Because if the market goes up by 1%, you want to try and better the market performance, right? So your portfolio, you try to increase by more than 1%. For that, you need the beta to be more than 1. But if the market is going down, that means negative returns, right? So you will try to minimize the damage on your portfolio. So if the market changes by 1%, you will want your portfolio to change by less than 1%. Understood? That is the importance of beta. You should have a reasonable idea whether you have beta more than 1 or less than 1. If the market is going up, you should ideally have beta more than 1. Market going down, ideally beta less than 1. Strategic asset allocation. Set of weights for each asset class depends on the long-term expectation about market. Right? Top-down or bottom-up approach can be used. Now, strategic means you take a long-term view of markets, not a short-term view. You look long-term, maybe top-down or bottom-up. That means you maybe start, top-down is you start from the macro picture, the bigger economy, right? What is happening to the economy? Based on the economic developments, what are the best industries to be in? Out of those industries, which one companies are doing well, right? So if you think healthcare sector is doing well, out of the healthcare sector companies, which one individual company is doing well? Then you try to figure out or forecast what is going to be the next year's performance, what will be the revenue, what will be the cost, and what will be the bottom line as a result. So that is called top down. You start from the macro, come down to the bottom line or the profitability of a company. Bottom up is the other way around, right? You start with the target profit level. Then to achieve this target profit level, what would be your cost? How much of cost have you got to incur? What should be the top line? And to achieve the top line, which industry have you got to be in? right? So that is called bottom up. Okay, so there are two types of strategic, top down or bottom up. Tactical asset allocation, right? So strategic means long term. So the board of directors and all that will get involved in strategic, whereas tactical is more shorter term, medium term. Maybe the senior management, the CEOs, and the top corporate management will get involved to decide tactical asset allocation. Slightly deviates from strategic asset allocation, depends on shorter term view. Then dynamic asset allocation means based on market trends, you try to adjust, right? You either increase exposure to certain companies or reduce based on market dynamics, right? So that's why it's called dynamic asset allocation. It involves frequent adjustments of investments in line with the performance over time with market trends. So you have to be in the market more often, you have to be trading more often, and you have to adjust your portfolios based on market movements. So that's why you have to be dynamic. It's considered as a risky strategy because you're getting in and out of equity, right, or markets. Does not involve keeping a fixed investment ratio. So the investment ratio depends on your view of markets, right? It can keep changing very frequently, might change within the day. It is about evaluation of current trends and predictions of future trends on investments, which are very important for dynamic market asset allocation. Right? So it's about how well you can read the market. Are you good at reading the market? Can you, with a reasonable level of accuracy, forecast what is going to happen in the future? Things like that. That is called dynamic asset allocation. There are three types of asset allocations: strategic, tactical, and dynamic asset allocation. Right? Dynamic is a more intraday asset allocation. Strategic is the top level asset allocation. Tactical is somewhere in between, and dynamic. Okay. Right. So that was a bit of a tough session, but the good news is the questions that you get will not be difficult, right? You will get things, maybe worst case will be on diversification, right? There might be a small question on diversification. I'm not targeting any questions. You have to know the entire syllabus, but the areas that can be tested, if I was the examiner, I will test on diversification. I will test whether you understand the concept of diversification, things like correlation and all that. Right. So if you know diversification, correlation, then this should be very, very easy. Okay, so well, time is almost up. Next week's class, I'm not 100% sure. I will let the institute know. Right, we may have to cancel. If so, I will let you know. Right. Any questions from today? Yeah, any questions? If there are no questions, maybe we can wind up. If so, I will let you know whether next week's class is on. Right, so if that is the case, thank you very much. I will see you at the next class. Stay safe. Thank you, guys. Thank you.